Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today. During the first segment, we started talking about some of the market implications following President Obama's re-election victory and how the market sold off sharply. What are the reasons for that? I went through four reasons. Number one, some speculative traders betting on Romney's victory. They had to unwind those positions. Number two, the fiscal cliff. Number three, the continued problems in Europe. Number four was the technical indicator of the market dropping below the 200-day moving average. Now, I cover this. I want people to try to understand, what's going on in the market. It does not necessarily mean that you should run out and actually do anything, and we're going to talk about that in a minute. But knowledge is power, and when people understand what is going on, they can become more comfortable with some sort of a long-term plan. And so if you understand what's going on, and why the market's going up and down and things like that, and kind of get a general understanding, it doesn't mean A, that you can predict it, or B, that you can profit from it, but hopefully we can help you understand it so that you don't become panicky and sell out at the wrong time. The other thing that these are sort of short-term things that I talked about, but long-term, the reality is we are well past 3 years into a bull market that started in March of 2009. Corporate profits have been higher than ever, and we're starting to see some signs of corporate profitability starting to subside a little bit. And just from a simple calendar basis, it's been a while since we've had a significant bear market. And so all these things are weighing on investors that typically bear markets come in cycles, and it's been, a good 3 years since one. And so people are just starting to get concerned. Now, whenever we see these pieces of economic news or fiscal cliff or re-elections, and we see people begin to question if it's a good time to be invested. They say, well, gosh, should we get out of the stock market? Last year it was the downgrade of the U.S. debt and people just panicking and getting out of the market. And so people tend to view these economic events and question their long-term plan. And that's why it's important to have a long-term plan, to understand what you're doing, why you're investing, what sort of risk tolerance that you have. And so I just want to reiterate that making large changes to your investment portfolio based on economic news is a really bad idea. You out there, even Wall Street, the majority of Wall Street thinking that they can take the election of President Obama or the fiscal cliff or something like that and distill it into something in the market that is going to be profitable for them in the short term. It's just not realistic. The evidence is really overwhelming that markets are not predictable, especially over the short term. As you lengthen the time horizon out, 7, 10, 15 years, there begins to be some elements of predictability. Now, not, 7 years to the day, but, on an average, if we look at today, where we think things will be in, 7, 10, 15 years, there's some degree of predictability. And by that I mean sort of relatively speaking, will bonds return more than stocks, or, will this, Asia versus U.S., those decisions are very difficult, but the general, stocks versus bonds type decisions do get some sort of predictability. As an example, at the end of 1999, the bull market, the dot-com era, who would have predicted that the markets were going to do so poorly? At the end of 2007, just a few, 5 years ago, markets were at an all-time high. China, emerging economies were taking over the world, the next greatest thing. Who would have thought that we would have seen a sustained market downturn from 2000 to 2002, and then 2007 to 2008? By the flip side, in 2002, who was out there proclaiming the good news of the economy? It was all awful news. Beginning of 2009, who out there was saying, oh, this is a great time to invest? The economic news was just awful. But the reality is what followed that awful, awful economic news was a very positive time to be invested in the stock market. And so selling and buying, changing your asset allocation based on the news of the day is just a really bad strategy. And typically what you see is people end up whipsawing their portfolio at exactly the wrong time. There's always a number of positive things and a number of negative things weighing on the markets. And that you got to remember that it's not the economic expectations themselves, it's humans' opinion of those expectations that go out and cause them to do things. So for example, it's not the fact that inflation goes up that causes the stock market to fall. It's people's expectation of what's going to happen as inflation goes up, and then they go out and they sell stocks and drive the price down. And so a lot of that is already factored into current prices. I was talking with somebody the other day, and we were talking about how, okay, if you analyze this company and the earnings are going up, whether the stock price goes up, what you really need to figure out is not whether the earnings are going up, but how those earnings going up will be perceived by everyone else, because that's what's going to drive the stock market up. And those people are trying to do the same thing. So it's really, can you figure out how those people are going to perceive what everyone else is perceiving is happening? I mean, it's just sort of this infinite degree of prediction that it's just not a winnable game. Well, that brings us to our second break. When we come back, we'll continue talking about what you should do with your portfolio based on what's going on today. So for All Things Money, I'm David Blain.